Hi everyone, it's PK here. Hope you're doing really well. Today I want to talk about should you be investing for negative gearing. So I think a lot of people are still very confused about what negative gearing is and whether that's something that they should be looking at and doing when it comes to property investing. Negative gearing is like often this term that colleagues or friends that don't fully understand it sort of throw around as if they're experts, like, oh I negatively geared my property, amazing tax results and all that sort of stuff. And it seems like a good idea, and it seems that that's how you do property investing. But let's just take a step back and actually explain what it is and reassess whether that is something that you should be pursuing. Okay, so that's what I'm going to be talking about today, and if that's useful, then give this video a like or a love on Facebook, so you'll see more of these videos. That's how the Facebook algorithm works. And if you're watching this on YouTube, just give a subscribe below, and then you'll get more of these sorts of videos as well. Okay, so what is negative gearing? In its most simplest sense, negative gearing is actually a tax outcome. All it means is that every year, all of your expenses from holding an investment property, like council rates, maintenance, property management fees, all those sorts of things, interest, all of that is more than your rental income. So what that means is that you're making a loss. If your rental income is $20,000, but all your expenses are $25,000, then that is a negatively geared property. You are negatively gearing that property, which means that you've made a loss of $5,000, and that loss of $5,000 means that you've reduced your taxable income for that year by $5,000. So let's say you made 100K from your job or from your business in that year, and you've made a loss of $5,000 from your investment property. It's negatively geared. So in Australia, what the ATO allows you to do is say, all right, well, I only made $95,000 from my job or from my business. You subtract that 5,000. And so therefore you pay less tax. There's less taxable income. But there's no two ways about this. When you negatively gear, it means you've made a loss, right? And I've done a video on previously on how this is a bit nuanced, on how you can actually have positive cash flow property that is negatively geared. But just for this video's purpose, I'm just going to say that negative gearing means that you've made a loss. And yes, it allows you to reduce tax. And I know that many of you that are watching this video will be on high incomes, maybe 150K, 200K, 250K, 300K household incomes. And you have been taught by colleagues and friends to negatively gear because you want to save on tax. And yes, making a loss means that you'll negatively gear and save on tax. But that is only the start. Okay, so the tax outcome is only one side of the equation. And there are plenty of companies out there that will try to sell you a brand new house and land package or an off-the-plan apartment and say that the passive income that you're making is enormous, but mostly that is from the benefits of negatively gearing, which means you're actually that passive income is really just a product of reducing your tax. You're just getting some tax back. So tax is reduced in essence when you make a loss, right? So think about this. What negative gearing effectively is saying is that if I make $10 of loss, I'm going to get $3 in tax back. Let's assume you're on a 30% tax bracket. Or to extrapolate that to more real figures, if I make a $10,000 loss from my property in a single year, the rental income is $10,000 less than all the expenses, then I'm going to get $3,000 tax benefit, a $3,000 tax rebate, if you're on a 30% tax bracket. If you're on the highest tax bracket, 45%, then you get $4,500 back. So on the face of it, on the surface of it, at the very superficial level, it seems like that's a great outcome. I've got tax back, but don't forget, tax is only rebated to you if you've made a loss. So what you're effectively saying is, I'm happy to make a huge loss for a small tax benefit, right? It's not that you get a one-to-one benefit. It's not that if you make a $10,000 loss, there's a magpie right beside me. It's not that if you make a $10,000 loss, you get $10,000 tax back. You only get your marginal tax rate back, right? So let's say 33, 37%. There's lots of birds around me at the moment. All right, so hopefully that's making sense so far. So that's what negative gearing is, and it's not a bad strategy, but the more important thing to look at is the capital growth of the suburb. And the capital growth has no correlation with whether the property is negatively geared or not. So for example, if you're in a high tax bracket, you're probably thinking, PK, all you're saying is great, but look, I just want that tax back, all right? I'm here to say that you can have a negatively geared property that increases by 100% over 10 years, or 50% over 3 years, or whatever the case may be. And you can equally, and just as likely, in fact more likely, have a negatively geared property that reduces in value or stays very similar or doesn't grow that much. Equally, you can have a positively geared property that increases massively in capital growth. And you can also have a positively geared property that reduces in capital growth or doesn't increase in capital growth as much. Whether a property is negatively geared or positively geared has very, very little bearing on its capital growth prospects. Okay, I hope that bird is not too annoying for you guys. So how much a property grows in value has very little bearing on whether it's positively geared or negatively geared. And so there's this sort of age-old myth that negatively geared properties grow in value. Or if I say it the other way around, the properties that grow the most in value are negatively geared. And that's simply not the case, okay? That's not the case. There are hundreds of properties that you can buy that are positively geared that grow as much, if not more, on a percentage basis as negatively geared properties. So I'm not here to say what you should be doing exactly, but the take home is this. Negatively geared properties means that you are losing money and just getting a bit of that back, bit of that loss back in tax. And if you want capital growth, then you don't necessarily need to buy a negatively geared property. You can as well buy a negatively geared property. It's not to say you shouldn't, but you don't need to, right? I mean, there are dozens of properties that have been bought by clients over the years in places like Canberra that are negatively geared and have gone up by $100,000, $200,000 in a couple years, 2-3 years. Equally, clients have bought dozens and dozens of properties that are positively geared that have done that same capital growth performance. So the main thing that I'm trying to teach you here is property economics. I'm not trying to give you a lesson in what you should do specifically. That's a very specific strategy, but understand what negative gearing is and understand that it has very little correlation with capital growth. Okay, so hopefully that was somewhat useful. And if you really want to generate a passive income from property investing over the long term, it's a good idea to not have every single property negative geared. In fact, it's a good idea to buy positively geared property, but unless you're on a very high income, $300,000 household income, you can afford to actually, if you're on a high income, you can afford to have 1 or 2 negatively geared properties, but don't fall for the trap that you must have negatively geared properties in order to achieve massive capital growth. That simply is not the case. And I know that there's always that sort of trade-off, positively geared versus growth. That's not a trade-off you need to make. It's possible, entirely possible, using data to find the combination of positively geared property and capital growth property. All right, guys, well, hopefully that was super useful. If it was, then just like or love this if you're watching on Facebook, and you'll get more of these videos. And if you're on YouTube, please subscribe below. And most importantly, if you have questions, I want to genuinely help you. If you have questions, just comment below as well. I'll reply to every single one of them. And I'll also leave a link below on how you can learn more about how to buy the combination of positively geared property and capital growth, and also how to buy the combination of negatively geared property and capital growth. The one consistency that you should never sacrifice is capital growth. All right, guys, my name is PK. Take care. Bye.